Yeah, in this session, we'll focus on the capital allocation and the performance measurement approaches, where the focus is mostly on the risk adjusted return on capital, how it is being used typically for allocation of economic capital. One important see, when we are finding out the economic capital, and after that I have to allot this economic capital to each project level or to each business unit level, right? Once I determine the economic capital at a firm level and I want to allocate it at a business unit level or to a particular risk type, what are the mechanisms that I typically have? So that is what is being looked at. Especially, there is a differentiation that we are going to look at between the loan products which are there with the bank along with the non-loan products. When I say non-loan products, there could be some kind of investments which the bank has done or some other kind of assets which the bank is having. So for each of them, how do I typically go ahead in terms of allocating this economic capital? And generally, the allocation is done based on the risk adjusted return on capital kind of a mechanism. So that's where we'll try to spend some time in terms of understanding in more detail on this risk adjusted return on capital. To start with, if I am going with this measure, as we all understand, very straightforward, risk adjusted return on capital. In normal case, when I say return on capital employed, this is at an organization level. Now, when I am looking at multiple projects, each project could be having a different level of risk. Now, what I want to know is, because this is having different levels of risk, their returns also should be different. So my return on capital overall may be this number, but because each project is having a different level of risk, I need to know what should be the returns in case of each of the projects. So that is where I am interested in. I cannot allocate the risk uniformly across all my projects and across all my business unit. So it is entirely dependent on understanding the risk associated with it. So especially when we are talking about the enterprise risk level management, and from there we have understood that this is the economic capital that needs to be set aside, or that needs to be taken care of for making sure that the unexpected losses are covered. The allocation of that capital at the individual business units level can be done through this RAROC methodology. So all the risk associated with the capital is mapped with the returns. So which will help me in taking unbiased and efficient allocation and the risk return decisions accordingly. So that is one of the key benefits that comes out with this RAROC kind of an approach. And if at all I have to differentiate between economic capital and the regulatory capital, right? In case of economic capital, we are talking about the protection against unexpected losses, because the expected losses, generally there will be a provisions that would be created in the financial statement. So expected losses need not be looked at from the economic capital perspective, but economic capital primarily focuses on unexpected losses, and from a definition standpoint, it's a kind of a confidence level. So generally when I say 95% confidence level, the economic loss is set, or probably economic capital is set at a 95% confidence level. What does that mean? There is a 95% chance or probably I am 95% confident, or probably there is a 95% chance that the actual losses that are occurring in a specific period will be less than economic capital only. I am setting the economic capital at that particular level where it tells that there is a 95% chance that whatever are the real chances that are occurring, they will be less than economic capital itself. So more or less sounding like a definition of value at risk only. So that's where when the details of economic capital and all are not available, probably I can use even a value at a risk as substitute to the economic capital also, because economic capital generally is at a firm level kind of scenario, whereas the individual value at risk can be market specific, market war, credit war, they could be at various risk types also. So that's where people can compute the economic capital based on the credit, market and operational risk, finding out their interrelationship between those various risk types. And the other way you should look at is, whenever I talk about the economic capital or unexpected losses, first I look at the worst case VAR itself. Probably when I am talking about 95% VAR, I will find out what is that amount that contributes to that 95% VAR. From there I subtract the expected loss. So that is the proportion. So generally if this is already in dollar terms, this much is sufficient enough for me. But if this is in percentage terms, I will multiply it with the loan amount to compute. This could be the possibility of economic capital. The intention of the economic capital is majorly to give a confidence to the investors that there is a very slim chance that this firm will default in the next 1 year, or probably whatever is the time period. There is the chances of default are very lesser, and if at all some worst case happens, this company has sufficient backup reserves to fund for them. That is what is one of the things that is given by the economic capital, and of course it can help in efficient allocation of the funds and the resources, which will actually help in terms of the overall performance of the firm, thus resulting in share value increase also. Shareholders' confidence increases, the share value of the firm will also increase accordingly. When I talk about regulatory capital, I have to appreciate that it is purely based on regulatory guidelines. So in some cases it may be more than the economic capital, and in some cases it may be less than economic capital. To a large extent we see that it will be less than the economic capital itself, which means the firms don't need to do anything excess to manage that economic capital, to manage that regulatory capital, because they anyhow will go up to the extent of economic capital, and because the regulatory capital is less than that much itself, there is nothing excess the bank or firm needs to do to meet up with the regulatory guideline. But this is primarily the regulator's perspective, whose objective is to ensure that the banking system, there is sufficient amount of capital that is present in the system. So that is what is the objective of a regulatory capital, whereas with an economic capital, the intention is to make sure that the investors are highly confident that their investments are safe and the firm or the bank is not going to default on their investments. They have sufficient capital to address the investors even if something worst happens. So those are some of the things that are being discussed as a part of the economic capital, right? Then how do I compute the RAROC, the risk adjusted return on capital? We will see first for a loan portfolio. On a loan, if a firm has to compute risk adjusted rate of return, all we are saying is take the risk adjusted return on the numerator and risk adjusted capital in the denominator. So whatever your capital that is invested, how much return you are getting for that. So for that, or what is the capital you have given as a loan, you adjust for the risk and compute that, and also compute what is the return that we are getting on that. And on that, generally the formula for the risk adjusted return is, you first identify what is the revenue you are getting on the loan. Okay, I have given a loan for I've given a loan for 10 million, and probably I'm charging 8% interest rate on that. So probably 0.8 million, or let me take 100 million for simplicity. I'm giving a loan for I've given a loan for 100 million in a particular business unit, and the interest on an average I'm getting 8% return on that. So my gross revenue for this period is 8%, and I am expecting probably 1% of these people will default. So let's say my expected loss is 1 million, and my expenses with respect to the loan, probably I am raising, where am I funding for that loan? Probably I am funding it from my depositors. So on my saving bank deposits, let's say I am giving a 4% interest. So on 100 million whichever I am taking from my depositors, 4 million has to be paid to my depositors in the form of interest. That is what is the loan expenses, which is primarily to do with the expected interest rate on the capital which you have got as a bank. Then whatever is this 100 million capital that I have, the economic capital whatever is there, right, whatever is the economic capital that is set aside. So let's assume that because it needs to meet the regulatory requirement, probably for this 100%, I'm assuming that 8% of it is the economic capital. So that 8 million, right, 8 million is set as my economic capital. That would be reinvested because I'm not, I need to have a reserve for that 8 million. So that 8 million would be invested somewhere, especially in high liquid kind of assets. It would be invested there, which means the returns that I am getting on this high liquid assets, let's assume that I am getting only 5% on this high liquid assets. So I would be definitely getting on 8 million, 10% is 0.8, 5 million, 5% is 0.4. So I'll get a return of 0.4 million during this period. And if at all I have some kind of operational expenses, non-interest related, probably some documentation stuffs or some kind of legal or administrative kind of an expenses. So if I assume some 0.5 million is going towards that, this is what I compute as the risk adjusted return. So in this case 5 plus 0.4, 5.4 minus 0.5, so sorry, 8 minus 1, 7 minus 4, 3, 3.4 minus 0.5, 2.9 divided by 8. So whatever is coming out, that is what is the return on my economic risk adjusted rate of return. And in the denominator for the risk adjusted capital, I should try out for the economic capital itself. Otherwise, probably if the economic capital information is not available, I can even use VAR, value at risk, as a proxy for the economic capital also. So the simple way I should interpret this is, whatever is this amount, let's say around 35% or 30, whatever it is. So this is the expected rate of return on the equity to support the loan. So that is how I compute risk adjusted rate of return for an equity, for a loan kind of a portfolio. Now the biggest challenge comes, especially if I have to allocate the individual risk, right? Individual risk as a risk adjusted capital. If I have to allocate to each of the risk types, how well I can do it. Now, when I look at the market risk, this is the market risk cost of capital charge, wherein we are saying, okay, for every department, we are fixing a VAR limit. Based on some level of confidence, we compute the VAR limit for it. So let me assume that VAR limit for a particular department I have given as 50,000 in a particular period. So it goes with whatever is the VAR that organization or that particular business unit has got into, and it is compared with the VAR limit. So let's say the VAR limit is 50,000 and in a particular period the VAR was only 40,000. The actual VAR was 40,000. So what we say is, in this period there is a shortage of 10,000. So unused VAR, that is the simple scenario of unused value at risk. There is a penalty for this, and at that penalty is F2. Similarly, if it is excess use in a particular period, let's say if the actual VAR was 60,000 when the limit was 50,000. So for that 10,000 which was excess also, which is what we call as excess VAR, even there is a penalty called F3. So when we are trying to allocate across the various business units, what we are simply doing is, for each business unit we are defining the VAR limit, and based on that VAR limit we are trying to compare the actual VAR with that VAR limit assigned and building an equation. So we are coming up with three variables called F1, F2, F3. The F1 is multiplied with the actual VAR itself, whereas F2 is multiplied with whatever is the unused VAR, and F3 is multiplied with excess VAR. And F1, F2, F3 are determined by the F1, F2, F3 can be obtained from the market, or they can be determined internally through usage of various models. But what we are saying is, either this will exist or this will exist, because either the person would have overused or underused the VAR, but if it is exactly used the same, then both of them also may not exist, but both of them together cannot exist. That is one way this model has been designed. But excessively used VAR as well as shortage VAR, both of them are penalized. So the market risk charge, capital charge, is coming out from this particular formula. And one more thing is, when I talk about the market risk with respect to banks, the major risk is a gap risk. It's better to understand the word, because gap risk is nothing but you are talking about the sensitivity of the assets versus the liabilities to the interest rate fluctuations. Probably it may so happen, if the interest rates increase, it may so happen that your value of assets will go up, but liabilities will not go up that much or will fall, and the gap widens, or in some cases the gap narrows down. So that is what we are calling as the gap risk, and one key element that needs to be considered when you are doing the allocations. Then when we talk about the credit risk, we are simply computing what is called as the capital factor, which is based on the credit quality and the maturity of your instrument. So all else remaining the same, longer the maturity, the capital factor will go up. So longer maturity, the capital factor also will go up, and at the same time credit quality down, capital factor will go up. So for each business unit level, you try to compute the credit quality and you try to look at the maturity of the various instruments, and you allocate the total capital based on these two factors. So you take the market value of the position and compute capital factor to it, and these capital factors also could be obtained from the credit rating agencies. Each one uses a different capital factor, or we can use some kind of proprietary models like your KMV models, or some publicly used kind of models called the credit metric. From wherever you can very well obtain these numbers, and based on that you should be able to allocate the economic capital to various business units and lines. Then the third dimension is the operations risk. Generally it is very difficult to allocate operations risk, but the biggest thing is most of the banks are suffering from heavy problems with respect to operations risk itself. And the only thing which people suggest is you try to give some kind of ratings to your various business lines and transactions. It could be to your business lines or it could be to your transaction. You give some kind of a rating to them based on various aspects. Either it could be through a questionnaire kind of a mechanism or through some kind of performance measures. You try to give ratings, and based on that ratings you try to allocate the economic capital, or probably the operations risk based capital to each of those business units. But remember, it's going to be a very challenging aspect compared to a market risk allocation or even a credit risk kind of an allocation. And in case I don't have a loan portfolio, I'm talking about a non-loan kind of portfolios like your investments or something, then the allocation will happen first by finding out the loan equivalent value. Even if they are not loans, what would be the mechanism? If it had been a loan, what would be the value associated with it? So you would be trying to find out the loan equivalent value. Then we will compute the risk factors, the capital factor in case of credit risk or all these things. Depending on what risk we are trying to compute, we will be doing the allocations by considering those appropriate standardized capital factors, and you multiply it with the loan equivalent value. And the most interesting aspect is how this risk adjusted rate of or return on capital has been changing over a period. Initially it all started off with project to project. Okay, for each project 1, 2, 3, I have a hurdle rate. I have a hurdle rate, right? Probably I call it as hurdle rate 1, hurdle rate 2, hurdle rate 3. 3 projects I am looking at, right? And I have based on some factor we have decided HR1, HR2, HR3 as the risks associated with each of the project, or probably the RAROC that is expected out of these projects. And at the same time I'll calculate the actual RAROC 1, RAROC 2, RAROC 3. Now the comparison is with the hurdle rate. So if in this case and this case the actual is greater than the hurdle rate, these two projects are accepted, whereas this project is rejected, which means the firm may on one side it may look that the firm is taking up only those projects which are adding value to the shareholders. it looks like this and this are adding value to the shareholder, but this is not. So it is so happening that the firm will take up only R1 and R3. But this in turn sometimes may result in a decrease in the shareholder value also. It need not increase the shareholder value every time. This may decrease the shareholder value also sometimes, especially when the company cannot use this capital effectively. The company is having an effective this much of capital with them, but because this is not giving them a kind of positive, RAROC greater than the expected RAROC, they don't accept this particular project, and that capital is not being utilized for any effective purpose. So probably the idle economic capital also could result in a decrease in the shareholder value. If at all the company is not able to identify sufficient opportunities for investing that capital, probably there could be a result of decrease in the shareholder value also overall. But after that, a mechanism has come wherein the RAROCs of each of the firms, that is what we call as a first generation mechanism, wherein RAROC of each of these firms, it is compared with one single number cost of equity. Now, this is what is the approach. We have computed the cost of equity as one single figure, which is an aggregation of the hurdle rates of all the projects put together. One single firm level cost of equity is found out, and the RAROCs are compared against that. This is what we call as the first generation RAROC comparison. And wherever this is greater than this, we are saying those projects are accepted, the other projects are not accepted. But here, of course, for the whole set of projects, we are assuming that the KE is constant, which means the probability of default is constant. Cost of equity is more from the perspective of the risk associated return on the entire project. So for all projects, on the entire firm. So for all projects of the firm, I expect that the cost of equity to be the same. If the cost of equity is expected to be the same, the opinion on the probability of default for all those projects should be the same. Which means the returns also I am expecting the return on equity or risk adjusted rate of, now there is nothing called risk adjusted return on capital. It would be same as ROE itself. The return on equity also I am assuming that it should be constant for all projects, which in reality may not be possible, because as the businesses keep changing, as the scenarios keep changing, we'll have different numbers. So it is very difficult to assume that return on equity is constant throughout the period. So to address those things, we have got into a second generation approach, where the intention is not R1, R2, R3 being compared with a cost of equity. Here we are adjusting R1, R2, R3 separately with the firm's beta. So how are we adjusting it? Each return I will subtract risk-free rate of return and divide it by the beta of the firm. So all of them will go through this R2 minus RF by beta, R3 minus RF by beta. So I am modifying the beta across. I am modifying the risk adjusted rate of return by subtracting the RF and dividing it by the beta. Now, according to me, this should be better than whatever the value which we are getting. This should be better than the risk premium, RM minus RF. So if at all this project is generating an RAROC which is greater than this one, we call that we try to accept that project, otherwise we reject it, which means you see this is the return that is generated by your project. I am looking at how much of excess return it is generating. So this project is generating an excess return of R1 minus RF. But that is if at all I adjust it with respect to beta, because if a firm is having a equity risk of beta, it should generate a minimum return of RM, excess return of RM minus RF. So what we are saying is, if the R1 minus RF by whatever the beta I am defining, it should be greater than RM minus RF, which means if it is having a higher risk, probably its return should be higher than RM minus RF, which is how for each of the business I am computing it like this and then doing the allocation. That is what we call as adjusted RAROC. So let's take some example. Initially, if the RAROC is, let's say, 12%. So this particular project has generated a return of 12% when let's say the risk-free rate of return is 5% and the company's equity beta is 1.2. And probably during that period the market has generated, let's say, 14% return. So what is that we are saying? I will look at adjusted RAROC, wherein 12% minus 5% divided by 1.2, 7 by 1.2. What is the 7 by 1.2? Probably around 6%. This is what is this particular adjusted RAROC. I am looking at what is RM minus RF, it's almost 9%. So because my adjusted RAROC is not greater than RM minus RF, I will not accept this particular project. I will go ahead in terms of rejecting this project. So this is how in a very brief understanding we can talk about the various capital allocations across the various business units, allocation of economic capital across the various business units by computing the risk adjusted return on capital. I hope you got some amount of understanding into this particular aspect of computing RAROC and adjusted RAROC for the projects, and how the allocations happen for loan portfolio versus non-loan portfolio. If you have any further queries regarding the same, you can very well get back to me by giving me a call on the number I have provided below, or you can even send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.